Hi, it's Doc for Module 2 of the Futures Masterclass. How do you actually make a profit trading futures? And once you do, how do you keep them? We'll cover those concepts in this module. In this video, we're going to be talking about how futures contracts gain or lose value as to whether you're short or long the contract and whether the price is going up or the price is going down. We'll also talk about the initial margin calculation. Now, this is the amount of money you need in your account just to be able to set up the trade at the very beginning. Obviously, this is important regarding the size of your account. I'll encourage you to read the module text as it's a better vehicle for communicating all of the soft challenges present to making money with any form of trading. In this video, we're going to stick to the more visual aspects of how futures contracts gain or lose value, as well as the margin calculation. We'll look at a couple of different brokers and show you how to make or lose money with crypto futures. We're not going to cover the evaluation process of whether the chart is setting up for a long or short trade yet. I know you want to get into that as soon as possible, but that comes in Module 5 when we start to discuss trading systems. For right now, I just want you to understand how the trading interface and the contract makes or loses money for you with a regular futures contract as well as a synthetic one, also known as a perpetual swap, and how a trade entry affects available cash in your trading account. Obviously, something that's very important. The first that we'll go over is BTC, or Bitcoin futures on TD Ameritrade, using the XBT contract underwritten by the CBOE. So we know that there's two official futures contracts. One is by the CBOE, and that's better for retail traders. The other one is underwritten by the CME, or Chicago Mercantile Exchange, in Chicago as well, obviously. And that one is 5 times bigger and not really meant for the retail trader. So we're going to focus on the CBOE futures. Let's see what the margin requirements are. We'll go through that calculation, and then we'll cut over to the interface. So if you go to the TD Ameritrade website and say, what does it take for me to trade futures at TD Ameritrade? You got to jump through all of these hoops here. You've got to get the right margin settings. You've got to go through options approval, advanced features enabled, everything like that. You've got to be approved for futures trading. Basically, you have to show that this is not your first time around the block. You also have to have at least $25,000 in your account. So once you're approved to trade futures, you still need access to this to add it to your account. So there's 2 steps to this. So first of all, you have to convince people at TD Ameritrade that you know what you're doing. And secondly, you need to add this to your trading platform. And understand, even then they're not done with you, because the exchange margin, or the at TD Ameritrade, is 1.5 times the basic exchange margin. Now, if we see how the CBOE determines margin, let's get into that for a second. So first of all, it's 44% of the current daily settlement price. What is that? Well, every day when the futures close at 0000 UTC, there's a settlement price for Bitcoin. And so what they're going to do is just take the closing price of that and assign the current daily settlement price. So in other words, if Bitcoin versus the US dollar is $5,000, that's going to be the settlement price for that. And we're going to take 44%, or the margin is $2,200 on the CBOE. Now, TD Ameritrade requires 1.5 times that. So if we take that 2,200, multiply it by 1.5 times, we have a margin requirement of $3,300. Again, assuming that Bitcoin versus the US dollar is at $5,000. So if it's $10,000, then we're going to obviously have an exchange requirement from TD Ameritrade for initial margin of $6,600. And don't forget, no matter what, the account minimum needs to be $25,000 just to turn on the XBT access. Now, one other word here is that these brokers, such as TD Ameritrade, can change the margin requirements at any given time. And this is what we typically see when we see the chart starting to move a lot, when the volatility goes way up of any asset like Bitcoin, all of a sudden you'll notice that the initial margin requirements go way, way up, and they can set those to be whatever they want to at any given time. So don't be surprised if all of a sudden, even with Bitcoin US dollar at $5,000, all of a sudden they want something ridiculous like $5,000 or even $10,000 initial margin to set up one contract of trade. They can do whatever they want to, whenever they want to do it. Let's cut over to the platform on TD Ameritrade and show how you would trade futures on TD Ameritrade using the XBT contract. Here's the TD Ameritrade interface, and if I just treat this Bitcoin contract almost like a stock, what I can do is I can just bring up the ticker symbol here, and if I trade this like any other product, then we're going to get the old standard interface into here, and what it shows is the current front contract right now, and this is going to be the March contract, and there's 17 days left to trade this March contract, and it's active. So you'll see these letters change. So XBTH means March, and you'll see that transition to probably M for June, and then you'll see U for September, and then Z for December, things like that. As long as Bitcoin, the XBT contract, uses these quarterly contracts, you'll see the same letters into there. And then next year, you'll see this XBT H20 and 21, etc. So that's kind of the nomenclature behind the contract itself. You can see, again, how many days until it expires, and that rolls over to the next front contract. You can see the last price for this. You can see the bid and the offer, the size of depth of market. Again, not very user-friendly for this. So if we wanted to, we can right-click on this and we can say, I want to buy or I can sell a single contract. And this is going to come down here for an order entry, and then I can simply figure out what the price is and then confirm and send that order. Probably not something that I want to do. This is not a very visual method of trading this contract. This makes me feel like I'm trading stocks back in 1989 or something. Here we have what's called the ladder interface that we can trade Bitcoin futures with. And this is kind of an industry standard. The reason why they call it the ladder interface is fairly obvious here. The price will ascend in minimum tick sizes. So each one of these steps is the minimum tick size to trade the XBT contract. I can either use these buttons up here to buy at the market or sell at the market. Of course, we know that we never do that. We never buy or sell at the market. We're always trying to work the price slightly to our advantage by using limit orders, but that's another topic which we'll get into later on. So simply what we're trying to do is we're trying to either use the left-hand side to buy a contract, so go long the contract, or we're going to go up here and sell, or we're going to short the contract for a bearish trade. Long for bullish, short for bearish. Now I've also got the auto send here disabled. So if I go down here and put a limit order in saying, okay, I want to buy if the price comes down here to 39.20, what it's going to do is bring up kind of the conditions for this. And currently with Bitcoin priced about 4,000, what you're seeing is the buying power effect is 25.76, which refers to that initial margin that we talked about. Also brings up the commission cost for buying and selling for round trip for this trade, which is $2.50 in, $2.50 out, or $5 round trip. Now I'm going to cancel out of that. Now we've talked about this several times so far. The per tick leverage of this contract, if I were to go long the contract, which is a bullish trade, and if I entered, say, at 39.50, if the price goes up by $5, Bitcoin versus the US dollar, my contract makes $5. So there's a one-to-one relationship between one contract of the Bitcoin XBT futures and the value that I get from that contract. So again, I'm just renting this contract and writing the gains or the losses. By the same token, say I went long at 39.50 and the price drops to 39.20 and I close out the trade at that point, I have lost $30. What's also nice about using the ladder interface with this is that typically there's enough screen real estate to be able to put up a chart And you can see if we do put a limit order in down here, you can see that actually reflected on the chart that shows that we do have an active order or even a position if it were to be filled. So this kind of shows you the advantages and the disadvantages, not only of the contract itself. Contract has a little bit of a disadvantage because of the fact that it's sort of granular because of the tick sizes here. $5 per tick, so we can't really fine tune an entry into this. And of course, this contract was designed back at the end of 2017, where a typical day in Bitcoin back then was about $1,000 range. And so a $5 tick size was nothing. But now with markets are a little bit quieter, this is a little bit of an issue because you can't really fine tune. You're losing a little bit of edge whenever you enter or exit this contract. The other problem that we can quite clearly see right now as I am cutting this video on a Sunday afternoon is that there's no movement in price because the exchange is closed right now. There is no trading on this contract, and this is why you're not seeing the price moving up and down or showing any activity whatsoever. The contract is closed and will not open up again for another few hours. All right, let's go back to the slides and let's summarize the XBT futures contract from the CBOE. Okay, what did we learn about that contract? Well, first of all, one contract gained or lost $5 per tick value. Those were $5 increments. Those were the minimum tick size on the XBT contract. My initial margin against my account, if I wanted to either establish a short or a long position, was going to be per contract $25.76 based on today's price of Bitcoin versus the US dollar. We could enter take profit limit orders, but you cannot use stops on this contract. So I can't enter a sell stop or even a buy stop. I can't buy stop my way into a position. I can only use limit orders with this contract. That is an exchange limitation, period, for this contract. The exchange goes dark for 48 hours over the weekend. The contract does not trade over the weekend. There's no price discovery. There's nothing. If you're in a position, you can't close it over the weekend. You can't initiate a new position over the weekend. You are stuck either on the sidelines or you're stuck in a position either making money or working against you if you're holding it over the weekend. Not a great position to be in. Generally, what we don't want to do is put ourselves into a position where we're at the whims of the market over the weekend. That, to me, is more gambling than anything else. So it's a great trading interface. The latter is a phenomenal intuitive trading interface, but it's got really chunky trading and charting due to that $5 minimum tick size. I'm sure that would be improved if we had a lot more volume and activity on Bitcoin at this point, but we do not. So I would say this is for larger US-based accounts only. Even though we're just talking about the XBT contract itself, which is the smaller of the two by a factor of 5, versus the BTC contract, which is underwritten by the Chicago Mercantile Exchange. So even this one is better. The XBT is better, but it's still for US-based accounts only, and it's only for larger US-based accounts only. It's not going to be for the guy down the street with a $1,000 account trying to break into futures trading. All right, now we're going to switch gears. We're going to see how you would do the same thing at a different broker. And that's one that uses synthetic futures or perpetual swaps, whatever we want to call them. And this is going to be Prime XBT. So we're going to look at doing the same thing using a different broker. Here is the Prime XBT interface, and what I want to start off with here is just going through the fees and conditions. Now, again, this is not meant to be a full review on Prime XBT. This is just an example of this is the type of broker, futures broker, that we're seeing in crypto releasing right now, which is sort of this synthetic futures contract using perpetual swaps. This was kind of pioneered by BitMEX, and now there's a ton of competitors coming along. And all of them are going to be somewhat the same in terms of how they do this, but you have to check with each one to make sure you truly understand how they control those contracts. All right, so for example, at Prime XBT, their minimum deposit here, and this is actually a little bit ridiculous because if you look at this with Bitcoin, let's say at $4,000 versus the US dollar, minimum deposit is the equivalent of $4. Okay, so they have a really low threshold of entry into getting an account here. So the leverage offered is floating, and we'll get into what this leverage means in just a second here. And the current pairs that they trade are Bitcoin versus the US dollar, Ethereum, Ripple, Litecoin, and EOS. And the commissions are flat fee per trade. Now, here's something that's a little bit different. The minimum price change is 0.1. Remember how in the XBT contract, the minimum price change was $5, but in this case, it's 0.1 BTC. So that is a heck of a lot more granular, and you can see how it is on the other contracts as well. Obviously, with Ripple being a very, very low cost, the minimum price tick here is actually fairly small. Here's something else to keep in mind is that the trading fees, this is what you would normally view as commissions. If you trade in and trade out of a position, you'll be charged 0.05%. Now, that's not 5%. That's 0.05% in and 0.05% out. Here's the difference, though. If you trade overnight, so if you trade past, say, like 7 p.m. Eastern Time, and that's 0 UTC. So let's say 0 UTC. If you hold a position past that time frame, you're going to get charged $3.90 per BTC to hold overnight. So that's a little bit different from the XBT contract where you weren't charged anything to hold overnight, although typically with a true futures contract, there is a different overnight margin. Going a little further down here, you can see that some of the other contract specifications, let's just focus on Bitcoin for right now. Minimum order size is 0.01 BTC, which would be the equivalent in today's price of BTC versus US dollar of $4,000. This would be about a $40 minimum size units, and maximum would be up to 15 BTC. But you never want to be the biggest dog in the patch at this point. It favors you to be the smaller trader. The problem is you could get into a roach motel situation where you check in and you can't get out. You can't check out. So you want to make sure you have exit liquidity as well as entry liquidity for your trade. Now here's the big difference is the margin requirements. Remember the margin requirements for the XBT contract were, I won't say they were fairly substantial. They're very much in line with any other futures contract that I've traded through an exchange. But as it relates to Prime XBT, they're much, much higher than Prime XBT. So the margin requirement for Prime XBT is 1%. So what that means is if you're leveraging 1 BTC, and let's say the price of BTC is $4,000 versus the US dollar, your margin for that is $40. A lot different from $25 or $3,000 on the XBT contract. So again, this very much favors the smaller trader that's just getting into retail futures trading. The leverage is 1 to 100, which in some cases does scare some people because that is like the maximum leverage of some exchanges like BitMEX. But you can always vary the position size. So even though there is leverage against this, you can always tone it down by making sure your position size is something that's well within your limits. All right, those are the contract specifications. That's how to use this type of broker with a synthetic futures contract. So this is the actual trading interface, and there's a couple of different ways that we can actually trade. Notice that we don't have the wonderful ladder interface like we had with TD Ameritrade and the XBT contract. That is, again, at least in my mind, that is the best way to trade. It's the most visual way to trade. Instead, what we have are these typical Forex-like controls that are here on the dashboard for buying and selling. Now, what you'll notice here is that also the price difference between buying and selling, the spread is actually fairly tight here. It's about $1.7. It's about $1.70, which is, again, a lot tighter than the spread of the XBT contract. So this isn't bad. Even if you enter a market order, this isn't that bad. You're not losing that much edge on this, although I typically never enter a market order. So let's say we wanted to buy this contract long. We're just going to hit the buy button here, and now we can enter our order. So right off the bat, we can see the difference between this versus a ladder entry. There's more than one click that's required. You can't just do single click orders on the ladder interface. We have to specify what's going on here. We have to say, well, let's not do a market order. Let's do a limit order. And instead of just that price up there, let's specify that we're going to buy at a certain price here, which is basically wherever we want this to be. So many times we're going to split the bids and offers in here and enter somewhere in the middle point there. We can also see the margin impact for this. So if we're leveraging 1 Bitcoin, which is this figure right here, then our margin impact is going to be 100 times smaller than that. But also notice that they're actually including the commissions into this. They're very clever here. So they're automatically including the commission cost into the price of the trade when they calculate your margin impact. So we're not going to get into all the fancy orders here. What we want to determine is, how do we make money with this? So we're going to make money with this at the same rate as 1 Bitcoin. So even though we only are leveraging 0.01, so 1/100th of a Bitcoin, which in this case is about, let's say it's about $40 or $38. If the price of this goes from, let's say, $38.60 up to 4,000. So if this is $38.60 and it goes up to 4,000 up here, so there's a difference of $140 in that. You will actually make $140. If you sell out the position at 4,000, you'll make $140. And you're only leveraging 0.01, which is $38. So your initial margin is $38, 38.6, and you have the ability to make on a 140-point move of Bitcoin versus the US dollar, you're able to make $140 out of that. Now, hopefully, that's not the size of your account, because if the price, on the other hand, goes down to $37.20, you'll also lose $140. So if you get it wrong on the long, you can lose $140 of this, yet your initial margin on this position was only, again, $38 for this. So this is where leverage is a double-edged sword. And you always have to make sure that you understand what your risk is on any particular trade, how it affects your overall trade capital, and understanding how to dial in that risk so that you're not risking more than a certain percentage of your account. And we'll cover that when we get into the risk management module of this course. So again, the purpose of today's video on this is just to show you that if you're leveraging 1 BTC using Prime XBT, it shows that there's a very low initial margin requirement for this, in this case, $38 for this position, and we can make significantly more than that $38 if we get a nice move on BTC, but we can also lose quite a bit, the same amount to the downside, if we get it wrong. So again, double-edged sword with that amount of leverage, but again, we don't have to be trading 1 BTC of leverage. We can actually drop this down to be significantly less than that. However, the ratio of 100 to 1 will still remain. Now, don't forget, just like any other futures broker or just like a true futures interface, we can go short just as easily as we can go long. And you saw in those terms and conditions, if we go back to this information and go down to fees and conditions, we saw that it didn't cost any more to go short versus going long. And that's not the case in every single broker that's like this. As we get it further into this class and start to look at different alternatives for different vendors, we're going to find that some of them are not quite the same long as short. And that's something that you need to evaluate before you actually start trading. Let's summarize what we saw for a minute here on the BTC USD contract on Prime XBT. So it trades at present 5 different large cap futures pairs. So we saw that you could not only trade Bitcoin versus the US dollar, but also Ethereum and Ripple and EOS and Litecoin. So if one's not moving, perhaps something else is, although they do tend to trade kind of in sympathy with each other. Leverage is fixed at 100 to 1 for smaller positions. That does change in a sliding scale as you get larger. You can go short as easily as going long. So just like the regular futures contracts, there's no difference between going short versus going long. Again, that is not the same for every vendor. There is an overnight holding drag. So if you hold a position overnight, if it's not moving, if it's not hitting your stop or your profit target, you're going to be charged a little bit of hold drag on this. You're going to be charged for them. This is how they come up with this perpetual contract. There are very low initial margin for these trades, but easy to create positions that could blow out your account in one shot. You kind of see what they do with the XBT contract and TD Ameritrade. They make it kind of hard for you to overtrade your account, or at least they make it more difficult. You can still do it. It's just you have to work harder at it. With Prime XBT, they make it very easy for a newer retail trader that doesn't know what they're doing to blow out their account in one shot. Trading interface is a traditional one. It's more of a Forex type. It's certainly not the advanced ladder interface that I prefer. And it does take several clicks to enter a position. You have to dial it in, set your price, set your position size. None of that is defined entering. So you have to do a little bit of work to get into a position. And assumingly, you have to do the same thing to get out of the position as well, too. Let's summarize things of what we talked about. Again, this module was to show you how to make money with futures contracts. And I hope that we've answered that requirement of how you can make and or lose money with futures contracts. Again, please check the written portion of this module out, the written text of this, because it's quite different in terms of the territory that I cover, and it may be as, if not more, important. So we saw how to make money and lose money with traditional and synthetic futures brokers. Traditional futures markets are biased to larger accounts and somewhat difficult to trade, at least with crypto. Synthetic futures markets are biased to smaller accounts and are easier to trade, although the interface is not as good, at least with this case. And it's just as easy to lose money as to make money. I want to make sure that we highlight that. Like a lot of the advertising makes it seem as though it's easy to make money with anything, but it's no different than anything else in trading, is that it's not what you make, it's what you get to keep that really counts. All right, in the next module, we'll look at how we can create an entire framework to create our trading business and treat this like a business and not just like a hobby. We'll see you there.